If you woke up tomorrow and your bank decided to freeze your account for 30 days, could you survive on the cash in your wallet right now? For most Americans over 55, the honest answer is terrifying. We are not talking about a cyber attack or a government conspiracy. We are talking about something that happens every single day in this country. Routine fraud alerts, a lost debit card, a system update gone wrong, or even a simple misunderstanding with the IRS that locks up your digital money with zero warning. Now, here is the real question nobody seems to ask. In a world where we can pay bills with our phones and swipe a card for a pack of gum, how much physical, tangible green cash should you actually be holding right now, not invested in the market, not sitting in a high-yield savings account that takes 3 business days to transfer? I mean cold, hard currency that is in your hand within minutes. For years, financial gurus have told you that cash is trash, that inflation eats it alive, and that idle money is lazy money. But if you are between 55 and 80 years old, the rules of the game have changed completely for you. Today, we are not chasing the hottest stock tip or trying to double your portfolio in 12 months. We are talking about the bedrock of your sanity, financial security that does not depend on a plug or a password. Welcome back. If you have been searching for straightforward financial wisdom without the jargon, you are in the right place. We talk about retirement, Social Security, banking, and the unique money challenges that face the seasoned generation. By the time we are done here, you are going to know exactly how much cash your neighbor should have in their safe, why the old 3 to 6 month rule might be dangerously outdated for you, and the specific number that lets you sleep through any storm. Stick with me because the specific figure I am about to share with you is not pulled from thin air. It is based on real-life scenarios where a power outage lasted longer than a long weekend, where a medical emergency required an immediate payment, and where a bank's computer system simply said no. Let us start by taking a trip back in time. Do you remember the way your parents or grandparents handled money? They had a cookie jar, a strongbox, or a specific envelope tucked in the back of the china cabinet. They knew that if the electric grid stuttered or the bank doors closed for a holiday, their grocery money was still right there. Somewhere along the way, we got sold a very sleek, very efficient lie. We were told that relying on physical cash was old-fashioned, dangerous, and that swiping a piece of plastic meant you were sophisticated. But what we sacrificed for that convenience was true immediacy. When you are 30 years old and a bank error freezes your checking account, you might be annoyed, but you can probably bounce back. You can borrow money from a friend, hustle a side gig, or just wait it out eating ramen noodles. When you are 70, the stakes are astronomically higher. You might have critical medications that need to be picked up today. You might need to pay a plumber who shows up at 2 in the morning and does not take Venmo. You might need to fill your gas tank to escape a hurricane evacuation zone. These are not hypothetical doomsday scenarios. These are the unglamorous real-world emergencies that happen to people in our community every week, and when they happen, the digital wallet in your phone becomes about as useful as a brick. The banking system in the United States is incredibly robust, but it is not designed for your personal liquidity crisis. Think about the last time you made a large purchase or transferred money between accounts. You probably saw the hold placed on your funds. Now imagine that hold happens not on a planned purchase, but on your entire primary checking account because a gas station skimmer cloned your debit card number. The bank, by law, must investigate. They are not punishing you. They are protecting you and their bottom line. But during that investigation, that money is frozen. It could be 2 days. It could be 2 weeks. If your grocery store doesn't take credit cards due to a network outage, or if your credit cards are maxed out due to an unexpected home repair you just paid for, you are stuck. This is why the concept of just-in-case cash is no longer a relic of the Great Depression. It is the most modern, sophisticated safety net you can build for the years when your nerves and your financial flexibility cannot handle a bureaucratic waiting game. Now, let us address the giant elephant in the room, the one financial advisors drag out to scare you away from holding cash: inflation. It is the monster under the bed that whispers, "Your money is melting." I am not going to stand here and tell you that inflation is a myth. It is real, and for seniors living on a fixed income, it is a silent thief. But there is a cost to liquidity, and there is a cost to rigidity. If you have 100% of your assets tied up in certificates of deposit with early withdrawal penalties, or in the stock market where a down week could wipe out a year's gains, you are paying a different kind of tax. You are paying a stress tax. If you have to sell a stock at a loss just to get $5,000 for a new air conditioner because your savings account transfer is taking 3 days, did you really beat inflation? The math says no. The psychology says absolutely not. The cash you hold in a safe place is not an investment. You do not hold this money to make you rich. You hold this money to stop you from becoming poor due to a short-term emergency. You hold it to buy peace. Peace has a price, and the loss to inflation on a few $1,000s sitting securely in your home is probably the cheapest therapy you will ever buy. So, let us get down to the numbers. You have heard the standard advice your whole life. Save 3 to 6 months of living expenses for an emergency fund. That advice was written for a 40-year-old who has a steady paycheck and a household full of people who can pivot. For the retiree or the soon-to-be retired, that rule is dangerously vague. For our generation, I want you to think about 2 specific buckets of cash. Bucket number 1 is your home cash reserve, the physical bills you keep in a fireproof safe or a similarly secure, accessible location. Bucket number 2 is your local bank cash, the money in a checking account at a brick-and-mortar bank where you can walk through the door and speak to a human being within 15 minutes. We are going to focus on that first bucket because that is the one people mess up the most. The most common mistake is keeping too little cash at home, thinking $200 or $300 is enough. Let me paint a picture for you. A severe storm hits your town. The power is out, and it is likely to be out for 5 days. Stores are open but running on generators, and their credit card machines are down. They are taking cash only. You need water, batteries, non-perishable food, and fuel for the generator you just borrowed from your son. That is not a $200 trip. That is easily a $1,000 trip. Another scenario. Your sister falls ill in another state. You need to get in your car right now and drive 10 hours. You need cash for gas, for cheap roadside motels that might not trust an out-of-state check or a flimsy card reader, and for food along the way. If you wait for the bank to open on Monday, you might miss crucial time. The world does not stop just because the markets are closed. For the majority of Americans aged 55 to 80, the target number for physical at-home cash should fall somewhere between $1,000 and $5,000. I know that spread sounds wide, but let us narrow it down based on your lifestyle. If you live in a suburban area, close to family, and have a well-funded local checking account, the lower end of that scale, around $1,000 to $2,000, is your crisis fuel. It covers the generator gas, the unexpected handout, the mechanic who tows your car and prefers a cash discount. If you live in a rural area, far from your primary bank, or in a region prone to natural disasters like hurricanes, wildfires, or blizzards that knock out infrastructure, you need to look at the higher end of that scale. For you, $3,000 to $5,000 in a waterproof, fireproof bag is the standard. This is not hoarding. This is ensuring your ability to navigate a localized crisis without standing in a 3-hour line at the one bank branch that has a backup generator. But here is where the narrative takes a sharp turn, and this is crucial for the 55 and older crowd. There is such a thing as too much cash. If you are a retiree who has lost faith in the banking system entirely and you have $100,000 stuffed in a mattress, you are walking a tightrope without a net. Physical cash is vulnerable. It can be lost in a fire, a flood, or a burglary. Homeowners insurance typically caps the coverage for physical currency at a very low amount, often just $200 unless you pay for a specific rider, and even then, it is minimal. Worse, it is vulnerable to the people around you. I cannot tell you how many heartbreaking stories I have heard of a caregiver, a struggling family member, or a smooth-talking contractor who saw a stack of cash and saw a solution to their own problems, not your emergency fund. Every dollar above your survival threshold that you keep in physical paper is a dollar that is not just losing value to inflation, but is also existing in a high-risk, uninsured state. The odd of this is balance, and balance is exactly where the banks come back into the picture. You need your physical emergency stash, but you also need a robust tactical checking account at a local bank. Do not keep all your operational cash in an online-only high-yield bank. The high yield is fantastic for your long-term savings cushion, but you need a local hub. You want to walk into that branch, and you want the teller to know your name. Why? Because when the system goes down nationally, or when a fraud alert freezes your online portal, a local banker who has seen your face for 10 years can often override, help, or verify your identity in ways an online chatbot never can. You want your monthly operating cash, the money for your mortgage, your groceries, and your utilities flowing through this local institution. The relationship you build there is your bridge to accessing your bigger, digitally locked up funds when the computers fail. Now, let us talk about the life stage you are in right now. At 60 or 70, your spending patterns are profoundly different than at 30. A 30-year-old might need an emergency fund to cover a job loss. A 65-year-old is likely on a fixed income from Social Security, a pension, or a structured withdrawal plan. The emergency isn't typically a job loss. It is a medical deductible, a home repair, or a family crisis. These events do not send a polite notice 2 weeks in advance. They demand immediate action. Think about a medical scenario. You fall and you are fine, but a visit to the urgent care is required. They ask for the copay. You hand them a credit card. But what if you are traveling? What if you are at a small clinic that charges a processing fee for cards? Cash is king. Think about the death of a close relative. You might need to fly out the next day. You might want to hand your grieving adult child a few $100s just to ease the stress of buying sandwiches for everyone after the service. You cannot Venmo a hug, and you cannot digitally transfer the comfort of immediate, no-strings-attached cash in a time of crisis. Here is a specific, highly practical piece of advice that most planning guides miss entirely. When you are deciding on the right amount for your home cash reserve, do not just pull a number out of the air. Sit down with a pen and paper and write out your 12-hour emergency scenario. Imagine it is 9 o'clock at night on a Saturday of a holiday weekend. The banks are closed until Tuesday morning. Your plumbing just burst. Water is spraying everywhere. You need a plumber now, not in 3 days. Emergency plumbing services in this country, especially after hours and on a weekend, can easily run $800 to $1,200 just to stop the immediate flooding. Then you need a cleanup crew or at least a heavy-duty wet vac. That is another few $100s. Then you need a hotel room for 2 nights because your house is uninhabitable. Even a budget hotel for 2 nights with taxes will push $300. Add in food, because you cannot cook in a hotel room without a kitchen, and gas to get there. That single 12-hour window just cost you close to $2,000. If you try to put that all on a credit card, what happens if the card is close to its limit? Or the fraud protection kicks in because it is an unusual pattern of spending. The plumber does not wait for you to sort out a phone call with the bank's automated system. He wants to be paid before he leaves the job site. This is the reality test. If your current home cash is less than $2,000, you are not prepared for a Tuesday afternoon, let alone a true crisis. Let's shift to the psychological warfare of retirement spending. This is a concept researchers call the pain of paying. When you swipe a card, it is almost painless. It is abstract. You do not see the money leave your hand. This can be dangerous for a retiree on a fixed budget because it leads to slow, insidious overspending. However, when you pay for a vacation or a big-ticket item with physical cash, you feel the loss. It is visceral. By keeping a meaningful amount of cash, you can actually create a better spending discipline for yourself. You allocate your fun money or your home project money into envelopes. When the envelope is empty, you stop. This is old-school wisdom, but it works even better for the modern retiree than it did for your grandparents because we have been desensitized to spending by a lifetime of plastic. You are not just protecting your safety with physical cash. You are potentially retraining your brain to be a better, more mindful spender. But please, I am begging you, do not mistake holding cash for an investment strategy. This is where the quiet danger lies. Watching the news talk about bank instability or a potential digital dollar can make you want to pull everything out and become your own bank. That is a primal fear-based reaction. Fight it. The vast majority of your wealth needs the protection of the FDIC and the structure of the legal banking system. If you are holding more than $10,000 in physical cash, you have crossed the line from prudent preparation into unnecessary exposure. There is no bank run that will be solved by you having 11 grand in a shoebox that the bank does not have. What you are actually doing is putting yourself at extreme risk of theft by a visitor who simply looks through your closets. It is a sad truth, but the people who target seniors often know exactly where to look for valuables. They know to check the freezer, the mattress, the back of the sock drawer, and the bookcase. If you must keep a larger sum liquid due to your personal circumstances, keep it in a local bank savings account that is linked to your checking. That money is FDIC insured up to $250,000. If the bank collapses, the government writes you a check, usually within days. The fear of losing access to your insured bank deposit should not be confused with the need for immediate on-hand spending power for a weekend crisis. Let us also address the family conversation that nobody ever wants to have. When you decide on a specific number to keep secured at home, you must designate one trusted individual, a spouse, an adult child, or the executor of your future estate, to know where that cash is located. This is not about distrusting yourself. This is about the unpredictable nature of aging. If you have a stroke and are hospitalized for months, the insurance premiums and the house payment might still need to flow. If you pass away suddenly, your family will have enough grief without the frantic, chaotic treasure hunt of tearing your house apart looking for an envelope of money you hid so well nobody can find it. That conversation is awkward, but it is the final piece of the responsibility that comes with holding a cash reserve. You do not want your legacy to be a fight over $10,000 of moldy, forgotten bills that were stuffed behind a water heater. As we reach the final stretch, let us bring this all together. The new retirement reality is not about how much you have in your 401k when it comes to sleeping at night. It is about how quickly you can protect your home, your health, and your family when the system goes dark for 48 hours. It is about recognizing that at this beautiful, seasoned age, convenience is a luxury, but self-sufficiency is a necessity. The bank is not your enemy, but it is also not your mother. It will not bail you out at midnight. Only you can do that. The right amount of cash in the bank is the 90% of your liquidity that collects a little interest and waits for your monthly bills. The right amount of cash in your possession is that $1,000 to $5,000 that stands ready to be your bridge over troubled water when the digital world takes a coffee break. So, here is your final takeaway. Number 1, open your wallet right now, or however soon you can, and take an honest inventory. If you do not have at least $1,000 hidden safely in a fireproof container at home, make that your immediate priority, even if you have to take a small withdrawal over a few weeks. Number 2, look at your local bank. If you do not have a local bank where you can walk in and shake hands with a manager, open an account this week. The relationship is worth more than a slightly higher interest rate from a nameless entity on the internet. Number 3, never lose sight of the fact that cash is not an investment. It is an insurance policy on your own sanity. It does not need to earn a return. Its return is the absolute certainty that no matter what happens at the processor, the server, or the trading floor, you are still in charge of your life. If this gave you a new way to think about the green bills in your wallet, take a second to hit that like button. It really helps more people in our community find this channel. And if you have not already, please subscribe. We have so much more to share about banking rules that seniors are breaking without even knowing it, and government programs you have paid into that are just waiting for you to claim them. Now, I want to hear from you in the comments. Do you remember a time when having physical cash saved your skin during an emergency? Or maybe you have been sticking to a rule about home cash that your parents taught you years ago. Share your wisdom or your story down below. You never know who might read it and finally make the decision to protect themselves. Thanks for spending this time with me. Go on and build that safety net, and I will see you here next time.